Hi, this is Dr.S.VALLUVAN from MBA. Welcome to teaching video of fundamental versus technical analysis. Topic 1 is basics of stock selections. What is stock selections? Stock selection is the selection of one or more stock or shares based on certain set of criteria in order to maximize the probability of meeting the trading or investment objectives. There are more than 5,000 stocks available for trading or investment. None can trade or invest in all at the same time. Hence, that means an investor needs to select a manageable number of stocks. There are two kinds of tools are available for selection of stocks. Those tools are fundamental and technical analysis. These are most preferred tools for stock selections. Before we go into further, let's talk about the fundamental valuation. The fundamental valuation is quite straightforward. All it takes is little time and energy. The goal of analyzing a company's fundamentals is to find a stock's intrinsic value. Now, what do you mean by intrinsic value? Intrinsic value is nothing but a true value or fair value of the stocks. In a stock market, the stock may be overpriced or underpriced. That means it may be overvalued or undervalued. No one can ready to buy if the prices of a product is overpriced. They will ready to buy only at a true value. Intrinsic value, a fancy term for what you believe a stock is really worth, as opposed to the value at which it is being traded in the marketplace. If the intrinsic value is more than the current share price, your analysis is showing that the stock is worth more than its price, and that makes sense to buy the stock. Although there are many different methods of finding intrinsic value, the premise behind all the strategies is the same. A company is worth some of its discounted cash flows. This means the company is worth all of its future profits added together, and these future profits must be discounted to account for the time value of money. That is, the force by which 1 rupee you receive in a year's time is worth less than 1 rupee you receive today. The idea behind the intrinsic value equaling future profits makes sense if you think about how a business provides value for its owners. If you have a small business, the worth of that business is money you can make from the company year after year, not the growth of the stocks. And you can take something out of the company only if you have something left over after you pay for supplies, salaries, reinvest in new equipment, and so on. A business is all about profit, plain old revenue minus expenses, which is the basis of intrinsic value. So this is the theory of fundamental analysis. The diagram depicts the types of analysis. As far as the fundamental analysis is concerned, there are two approaches. One is quantitative approach, another one is qualitative approach. So now let's see one by one. The fundamental analysis is a method used to find the true value of a stocks, which I told earlier. The current price of a stocks may not reflect the actual value of the stock. The stock may be overvalued or undervalued in the market. The fundamental analysis helps investors to study the health of the company and thus leading to the actual value of the stocks. This is done by using various qualitative and quantitative factors. In a quantitative approach, the numbers is being analyzed. The company's profitability, expenses, whatever the numbers there are in the financial statements of the company. As well as the qualitative approach, it talks about the staffs and the management qualities, directors, management, decision making skills. So everything will be coming into the qualitative analysis. Let's see the factors or the process in fundamental analysis. Actually, it is a top down approach. First, we do macroeconomic analysis, then we have to go for industry analysis, then equity valuation model, that is dividend discount model, then financial statement analysis. So these are the process through which the fundamental analysis is being carried forward. Thank you.